Hello and welcome back to the channel, where in this session I'll be taking you through a Principles of Costing Techniques mock exam. So this will be split into two parts. So part 1 will cover tasks 1 through to 4 and part 2 will cover tasks 5 through to 7. I hope you find it useful, and if you do, remember to hit that like button and subscribe to the channel for more AAT content. Let's get started with task 1 then, which is worth 8 marks and is about classification and relationship of costs. This task has parts A to B. So part A then, identify whether the following statements are true or false, and this is worth 3 marks, 1 mark for each statement. The role of financial accounting is to help with decision making, both internally and externally, using published financial results. So that one would be true. So within financial accounting, it does tend to involve a lot of reporting, where we're putting together a set of accounts which can be used both internally and externally to be able to make decisions. So financial accounting does tend to focus on what has happened already, i.e. in the past, but that obviously doesn't mean that we can't use that data to be able to then make decisions going into the future. So that first statement would be true. Statement 2. The role of management accounting is to help with decision making externally using variance analysis and budgets prepared in advance. So although a lot of the information within that statement is correct, it would as a whole be false. The reason being that management accounting focuses on decision making internally rather than externally. Therefore that one would be false. Statement 3 then. Management accounting can incorporate much more than just monetary values, including hours, tons, litre and miles. So this one would be true. So within management information or management accounting information, there are no restrictions like financial accounting. So financial accounting often has to be prepared to a specific set of rules and regulations, either by IAS, IFRS, UK GAAP. However, management accounting basically is governed by what is useful to the business. So it could include anything really that specific business would find useful. Now within a manufacturing business, information on hours, material used, litres used, etc. would be very useful, particularly to someone like a production manager. So that one would be true. Part B then is worth 5 marks, and it states identify the behaviour of the following costs. So the first cost is electricity with a standing charge. So electricity is nearly always semi-variable. This means that a standing charge, you have a fixed amount which doesn't change, and that would be, it could either be monthly or quarterly, etc. But then there would be an amount paid for the actual usage on top of that. So with there being a fixed element and a variable element, it would be semi-variable. The next one on the list then, annual subscription fees. That would be a fixed cost. It would usually be the same amount every year. Obviously there can be price rises, and a fixed cost doesn't mean that it doesn't move at all. It just means that it doesn't go up or down depending on the number of units made. So such as rent would be a fixed cost. However, rent can change. It can go up and down. We know that. Landlord may charge more year on year. However, it's still not a variable cost because it doesn't change in line with the number of units produced. Next one on the list then, production staff wages. Well, if it's production staff, we would class those as a direct cost and also variable costs because they would go up and down with the number of units produced. So that'd be a variable cost. Advertising would be classed as a fixed cost. Again, it doesn't link to the number of units that's being produced. The last one on the list then, raw materials used in production. This again will be a direct cost. And for the purposes of your assessment, truth be told, all direct costs will be variable. There are certain examples, but nothing that's tested within AAT. So we can assume that all direct costs would be variable. And raw materials, obviously, they are the materials that go into the actual product to make that particular product, and therefore would be variable, because the more that we produce, the more we would spend in raw material. So that finishes task number 1. We can now move on to task 2. So task 2 is worth 10 marks and is about costing techniques. This task has parts A through to D. Part A then, identify whether the following statements refer to planning, control or decision making, and again it's worth 3 marks, so 1 mark for each statement. The act of making a choice based on information received. Well, that's basically straight within the statement, isn't it? It says making a choice, so that would be decision making. The next statement then, forecasting at different activity levels. Well, forecasting as an activity is predicting future values, and therefore because it's predicting, i.e. planning for the future, it would relate to planning. And then a comparison of budgeted results to actual results. Well, this process is almost a check-in process. It's making sure or having a look how the business has performed in comparison to what it should have done or what it thought was going to happen. So this would form part of the control process. Part B then, identify which inventory valuation method best describes the following statements. So for this we need to pick between FIFO, LIFO and AVCO, 3 marks, again 1 mark related to each statement. So the first statement then, costs issued using the average inventory price. Well, it's kind of in the name there, isn't it? It says average inventory price. AVCO relates to the average weighted cost of inventory, so it would be AVCO. Next on the list then, as purchase prices rise, this method gives the highest profit. So in general, we would expect purchase prices to rise. This is the most common scenario, given the fact that we have inflation. It tends to be that costs don't go down. As we know, definitely from the last few years, that costs definitely do increase over time. So the method which would give the highest profit would be FIFO. Okay, now the reason for that is that with first in, first out, what we're saying is the lower price products are the first ones to go, leaving in our closing inventory the higher price products. Okay, remember this is with purchase prices rising. So first in, first out, the lower price goods, i.e. they were bought earlier and expected to be a lower price, will be the first to go. The remaining goods would form our closing inventory, and these will be valued at the highest price because of the rise in prices. Now, the way that this works within your profit or loss is that closing inventory is actually taken off your cost of sales. So the higher that closing inventory valuation is, the lower your cost of sales figure would be. Now, your cost of sales figure is deducted from your sales to achieve your gross profit. So the lower that is, the higher your gross profit figure would be. Now, I appreciate when you're doing this, particularly for the first time, or even if you've done it a few times, it's not the easiest concept to understand. And because you may not have looked at a P&L, or when I say P&L, profit or loss, that is, at this point. However, that is how it works. So because of the higher prices in the closing inventory and the closing inventory being deducted from your cost of sales figure, that would create a lower cost of sales figure. The cost of sales is then taken away from your sales, giving you a higher gross profit if your cost of sales is lower. So on to the last statement then. As purchase prices rise, this method gives the highest closing inventory value. Okay, well I've actually just described that, and again that would be FIFO. Okay, it follows exactly the same reasoning as I've just said why it creates the highest profit. Okay, think about in times of rising prices, for first in, first out, the lower prices or the lower valued inventory is going to be the first to go, and the highest value inventory will remain in your inventory. So that one would be FIFO. Moving on to part C then, identify which labour costing method is being used in the following scenarios. So this one is worth 2 marks. So again, just 1 mark for each. So scenario A, production staff are paid 35 hours per week at £17.50 per hour. Any additional time is paid at time and a half. And we need to decide whether that is time rate plus overtime, piecework, or guaranteed minimum payment. So this one would relate to time rate plus overtime. We can see that the production staff have got a base rate or base amount of time paid a standard amount per hour. However, any time over this, i.e. over the 35 hours per week, would be paid with an overtime premium. So this will be classed as time rate plus overtime. Scenario B then says production staff are paid £10 for each unit fully completed, with at least £600 being paid at the end of the week. So this will be classified as a guaranteed minimum payment. Reason why we know that, it says with at least £600 being paid at the end of each week. So if that wasn't there and it was just that production staff are paid £10 for each unit without having that guaranteed minimum amount at the end of the week, then it would have been piecework. But because we have that at least £600, it would be the guaranteed minimum payment. And then the last question then, 58 units were made in the week, taking the full 35 hours. Part D then is calculate the labour cost per unit for each of these scenarios. Round your answers to 2 decimal places, and this is worth 2 marks. So for scenario A, this is really straightforward because there's no overtime. They are just paid the 35 hours per week with no additional overtime premium. So it would simply be 35 hours times £17.50 per hour, which gives us £612.50. We then divide that by the number of units made, which was 58, which gives us a labour cost per unit of £10.56. It does come out at sort of £10.56.034448, but remember it says round your answers to 2 decimal places. So normal rounding rules would apply, and that would be £10.56. Scenario B then, production staff are paid £10 for each unit fully completed, with at least £600 being paid at the end of each week. So what we would do is we would take our 58 units and we would multiply that by £10. Don't think we need a calculator for that one. That would come out at £580. Now, because it says that there's a minimum of 600 to be paid at the end of each week, that would obviously be higher than the actual amount paid per unit of £10 because that only came to 580. So we would actually use the £600 for this one. So we would take our £600 because that is the guaranteed minimum amount, and that is higher than what we would pay per unit, as I've just said. So we take our 600, divide it by 58 units to get a cost per unit of £10.34. Again, it doesn't come out at an even number, but we just round that to 2 decimal places. And that covers at task 2. We can now move on to task 3. Task 3 then is worth 8 marks and is about recording costs. This task has parts A through to C. Part A then, identify how the following costs are classified. And this is worth 4 marks, obviously again a mark per classification. So not a load to add to these, truth be told. We'll go through, we'll select which one each relates to. However, there is a little bit of memory involved here. It's just something that you need to learn. It's more memory than logic, truth be told. So direct and indirect costs will relate to nature or classified as nature. Materials, labour and overheads is classed as categorising by element. Fixed, variable and semi-variable costs are classified by behaviour. And by department would be function. Just something you got to learn those. They don't tend to come up much after level 2. Do a little bit in terms of like element and nature, but truth be told, you don't actually have to remember the classification. You just have to know what to do with them. So we'll not spend any more time on that one. We'll get straight into B. Identify whether the following are advantages or disadvantages of coding systems. And again, 2 marks. So the ability to retrieve information easily and quickly. So fairly logical. This one, obviously having a coding system makes stuff easier to find. Therefore, that would be an advantage. And then easy to miscode a bill. I don't know how easily miscoding a bill would ever be classed as an advantage or just miscoding in general. So that would be a disadvantage. Right then, moving on to the next part. An accountancy practice sells various services to its range of clients. It uses an alphanumeric coding system in order to code its sales invoices as follows. So alphanumeric just means a combination of letters and numbers, which I'm sure you're aware of. So part C then says code the following sales transactions using the coding system provided above for 2 marks. So we just basically need to look at what the location, client and type of sale would be and put together the relevant code. So it's already given us one as an example, so we can kind of work from there. So completion by East Anglian office for client C, VAT return. So what we do is we'd look at the relevant location, which is East Anglia. So we'd start out EO and then the client. So it says for client C, so it would be 003. And then type of sale, so it says VAT return, so it would be VR. And then the last one, so completion by Devon office for client B, bookkeeping. So again, check the location, so Devon office would be DO. The client, so it says for client B, so it will be 002. And then for bookkeeping, which is BK. Nothing hopefully too complex there. So what we'll do is we'll end that task and we'll move on to task 4, 10 marks. And it's about calculating overhead absorption rates and looking at behaviour of costs. This task has parts A to B. So part A then, identify whether the following statements relate to fixed or variable costs. 2 marks. So the first statement then, unit costs remain the same with changes in activity levels. So if the cost per unit, i.e. the unit cost, stays the exact same, it's tempting to want to put fixed. You see the words remain the same and everyone immediately wants to go for fixed. However, if the cost per unit is staying the same, this would relate to a variable cost. So if we think about a variable cost being the costs that go into making a product, i.e. such as direct materials or direct labour or a combination of the two, let's say to make it easy, they were £10 per unit. If we then created another unit, it would be £20. If we created 3 units, it would be £30, 4, 40, 5, 50, etc. Now the total cost is obviously changing, but the cost per unit is staying the same. Okay, so that first statement would relate to variable costs. Unit cost varies with the changes in activity level. So again, you see changes and you straight away think variable cost. However, with it being the unit cost, what happens is we know that the total cost doesn't move when classified as fixed. Okay, so let's say without making any units at all, the fixed cost was £10,000. Now, If we make 1 unit, if we make 100 units, that is going to stay the exact same. However, when it comes to the actual unit cost, so the cost of making one product, a fixed cost per unit would change, because the more we make, the more that fixed cost is spread over those products. So, for example, let's stick with the total of £10,000 fixed costs. If we only made the 1 unit, that full £10,000 would go to making that 1 unit. However, if we made 2 units, that 10,000 would be split over 2, so it would be 5,000 each. If we made 4, it would be 2,500 each. So the more we make, the more that cost is being split over those individual units. So for this second statement, unit cost varies with the change in activity levels, it would be a fixed cost. Moving on then, Barrymore Limited produces a single product, of which the following budgets have been identified. Overheads were 95,000, the activity level was 2,500 units, and the labour hours were 3,000. The business is looking to identify how the different budgeted overhead absorption rates affect the unit cost. If they use machinery instead of labour, the budgeted machine hours are 2,000. Part B then, complete the table below to show what the budgeted overhead cost per unit would be at the 3 different budgeted overhead absorption rates. Enter all values to 2 decimal places, and this is worth 8 marks, so 1 mark per box. So we can see within the table that we've got overhead absorption method, the number of units or hours, hours per unit, and then the budgeted overhead absorption rate and the budgeted overhead cost per unit. So the first one is nice and straightforward. This is just per unit. So all we would do is we would take our budgeted overheads of £95,000 and divide it by the number of units. So it would be 95,000 divided by 2,500, giving you a budgeted overhead absorption rate of £38. Now, because this is being split over the number of units, the absorption rate is already the cost per unit. So this would be the exact same for the budgeted overhead cost per unit. So this would also be 38. Next, we move on to a per labour hours method. So they've budgeted to use 3,000 hours to produce these 2,500 units. So the first thing that we need to do is calculate how many hours it takes to produce 1 unit. So to do that, we would simply do the 3,000 hours divided by the 2,500 units. And that gives us 1.2 hours used to make 1 unit. The next part in the table then is the budgeted overhead absorption rate. So to calculate that, we would take our overheads and we would divide it by the number of labour hours used to create all units, i.e. the total number of labour hours. So it's the total budgeted overheads divided by the total number of labour hours. Therefore 95,000 divided by 3,000 hours. Now this would give you £31.67. So just bear in mind here, it doesn't come out perfectly at that number, but it says to enter all values to 2 decimal places. So when you do type that into your calculator, you're going to get £31.66666666 continuously. We just need to round that to 2 decimal places using normal rounding rules. So that would be £31.67. Then the budgeted overhead cost per unit. So to calculate that, we've calculated with this £31.67 here, the amount absorbed per hour. But we know it takes 1.2 labour hours to produce 1 unit. So because this is per hour, this £31.67, and it takes 1.2 hours, to get the budgeted overhead cost per unit, we would multiply our budgeted overhead absorption rate of £31.67 by the hours it takes to produce 1 unit. So that would be £31.67 multiplied by 1.2, which gives us our £38. Last on the list then is with machine hours. So we're going to use basically the identical technique we've used here for labour hours, but this time using machine hours. So the first thing we need to do, it states that the budgeted machine hours are 2,000. So the hours per unit, it would be 2,000 divided by 2,500, meaning that it takes 0.8 hours in machine time to produce 1 unit. The budgeted overhead absorption rate then would be again the total number of overheads, so 95,000, divided by the total number of budgeted machine hours of 2,000. And that gives us £47.50 per hour. Then to get the budgeted overhead cost per unit, we would do, again, same as what we did for labour hour, the budgeted overhead absorption rate of £47.50 multiplied by our hours per unit of 0.8, and that gives us a budgeted overhead cost per unit of 38. So we can see that the budgeted overhead cost per unit is exactly the same, okay, because we're basically taking those overheads and splitting them in 3 different ways, but the total overhead doesn't change, and we're splitting them over the same 2,500 units. It is worth noting, because this will never happen, I know obviously you're doing level 2 and that's what you want to focus on right now. It is worth noting though, because when you look at this at level 2, you might look at it and think, well, what is the point then of doing it in 3 different ways? However, if you do move on, I know it's covered slightly at level 2 as well, but if you move on to level 3 or 4, it does become a lot more clear really. And it's just because that it works out this way because you only have 1 product. So we have 2,500 units, but only 1 product. However, if you had more than 1 product, the chances are it will take a different amount of labour hours or machine hours to produce each product. They're not both, or the chances are they're both not going to take, 1 hour. One might take 1 hour, one might take 1.5 hours. Which means that the budgeted overheads that you're absorbing into that product will actually vary because you've got different products and different times that it takes to produce. So the longer it takes to produce, the more overhead you would allocate to that product. Okay, I just want to clear that up just in case anyone was wondering what the point was. There is a point to it. It's just that it almost doesn't seem that way, only having the 1 product, but different products, you would get a different budgeted overhead allocated to each different product. So hopefully that clears it up for you. And that does cover task 4. So we'll move on now to task 5.